Got it? All right. My name's Doug Ray. I think everybody knows me, and I just wanted to welcome you folks in. This is the second of our client education events that we're holding. We also have folks, I'm going to say hi on our YouTube channel, The Vault. Good. Welcome them in as well. Tonight it's going to be about long-term care. And let me say this to you, and I'll say it again when we close out. If anything you hear from Alecia tonight interests you and you want to come in and talk to us about that, just let us know, okay? Just call in and we'll get you scheduled. And you guests who are here, we do retirement planning, and I think we do it really well. It's a 4-series process, and what I'd like to do for you folks is to offer that retirement plan to you. It is absolutely free. There's no obligation. If you have a retirement plan, good for you. Maybe use this as a second opinion. Now, I want to put a bug in your ear. Next month is the 3rd client educational event. And it's going to be with KCO Day. Any WPTI listeners in here? Okay. Last year we had KC over, and he did the event for us, and it went over really, really well. So we're going to have him back. We're going to do some more food and drinks and things like that. It's going to be like a town hall meeting where you get to ask him anything you want to ask him. And I figure this is a perfect time because we're right up on an election year, right? So it'll be a good time. Let me introduce Alecia Barnette to you. Alecia heads up the long-term care division of Financial Independence Group. Now, Financial Independence Group is a company I have used since 1998 that does a lot of our back office stuff for us, especially with the long-term care, the life insurance, the annuity type products. And Alecia, I have known since 1998. In fact, the first piece of long-term care business I ever wrote was with that young lady. So Alecia, come on up and let's talk long-term care.
Thank you. I started when I was 10, just so you know. Just kidding. Thank you so much for being here tonight. This is a subject matter I'm very passionate about, and I know a lot of people don't think long-term care is interesting. I'm going to try to make it as interesting as I can for you all. Before I get started, I always ask the room, what is the first thing that you think of when it comes to long-term care? Nursing home. What else? Cost, yes. What else? Anybody been a care provider before? It's not easy, is it? Well, we're going to talk a little bit differently about long-term care tonight. And again, I'm not trying to lecture you tonight, so please feel free at any time to ask questions. It's not going to be disruptive for me. I really am here to educate you, and hopefully you'll take a few nuggets with you that you haven't heard before about long-term care planning. So with that being said, I'm going to get started. There are 4 common misconceptions when it comes to long-term care. The first one is, it won't happen to me. This is another question that I ask the room, is how many of you think you're going to need care? Raise your hand for me. Okay, that is way more, believe it or not, than usually people are willing to admit. Usually about half the room or less will raise their hand and they think that their neighbor is at a much greater risk of needing care. And actually, there is a really high probability that you'll need some type of care, and I'll talk a little bit more about that in a few minutes as well. Our next misconception is Medicare or Medicaid have me covered. Let me walk over here so I'm not in the way. How many people think the government's going to take care of us? I always get at least one chuckle when I ask that question. So Medicare has certain stipulations that go along with it. You have to be hospitalized at least 3 days. You have to be getting better, and it typically only pays up to 100 days of skilled care. It's really short-term care, not long-term care. Anybody familiar with how Medicaid works? Mysteriously. You have to spend your hard-earned assets to qualify. It's means tested. If you're married, you could leave your spouse impoverished. And the biggest thing is you give up control when you go on Medicaid. Typically, Medicaid does not cover care in the home. It's facility only, and I don't know about you, but I don't want to voluntarily give up my money to go into a facility. Our next myth or misconception. That's what my savings are for. If you're taking notes, there's a fantastic website. It's longtermcare.gov. There's a lot of interesting statistics in there. Who needs care, how long you might need care, what type of services are available. But most importantly, there's a link that you can click on that will take you back to the Genworth Cost of Care survey. In this survey, you can type in any location in the country. For example, let's say you live here, but maybe one day you're going to move to Texas because that's where your kids live. You can literally type in any zip code or location. It's going to pull up the local cost of care. Now remember, these are averages, okay? So keep that in mind as I'm going through these numbers. So here's an example of the Winston area. Can you see this? Okay, great. So this is showing 2023 numbers, so I know it's probably difficult to see. So for a facility, it's running around $9,200 a month. For assisted living, we're looking at $6,200 a month. And home care, we're looking at roughly $4,500 a month. Typically across the country, nursing home is going to be twice what home health care costs. But those are today's dollars. Keep in mind, if you need care 15, 20, 30 years from now, cost of care is going up. There's a neat little slide that you can project future cost of care. So as an example here, if you're 60, for example, and you need care at age 80, you can put it out 20 years. So in 2043, it's showing examples in the local area here. So now we're looking at roughly $16,000 a month for facility, $11,000 for assisted living, and $8,200 roughly for home health care. Most people don't understand that A, it's expensive, but B, if you don't have a plan, your money is your plan. So as we're going through this presentation, be thinking about this. If something were to happen tomorrow, which asset would you liquidate first to pay for it? This is my favorite and last common misconception. My family will take care of me. And I say this jokingly, but do they know that? Right? Take my family, for example. There are 4 of us. I am the oldest daughter in closest proximity to my mother. She's been twice widowed. My biological dad passed away when I was 4. My stepdad passed away at the beginning of the pandemic, so she's alone. I have an older brother who's 10 minutes away. I have a sister who's roughly 4.5 hours away, and another brother who's 5 hours away. She got pretty sick about 7, 8 months ago, and I went down every day for 2 weeks. Granted, I work full-time. I have twin boys. They're 17, so I'm really busy, but I love my mother. I drove down one way, an hour and 15 minutes, to take her food, to take her medicine, to make sure my mother was okay. Ask me how many times my brother, who was 10 minutes away, went to go see mom. 0. Now, I love my brother, and I would say that if he was sitting right here in the front, he might punch me, but I would say it nonetheless. He is not a care provider. He's going to go up, he's going to go over, do the heavy lifting. He's going to fix something if it's broken. He's going to, take stuff up to the attic, cut the shrubs. He is really not a caregiver. What is that going to look like when my mom needs care? What I can tell you, the biggest takeaway today is long-term care doesn't bring families together, it tears families apart. And I'll talk a little bit more about that in a few minutes. All right, so again, I said I was going to talk a little bit differently about long-term care today. So what's the goal when climbing the mountain? To get to the top. Actually, it's to get down the mountain successfully without breaking your neck and without breaking your back. So a lot of baby boomers have climbed that mountain. They've gone through what we call the accumulation phase. So they've saved, and they've started retiring in roughly 2017 and on. Now they're going through what we call the distribution phase. That's why you're hearing a lot about retirement and income planning from these guys, right? Because we have to spend that money that we saved for so many years. All right, so what are some of the issues affecting the descent? Anybody know what could be a big disruptor of income? Want to take a stab at it? Taxes, yes, I should put that on here. It's not. Inflation, absolutely. How about having enough retirement income? We're all living longer, right? Are we going to outlive our assets? How about market volatility? Anybody seen any of that lately? How about healthcare cost? That's a big one. But more specifically, an income stream to pay for care. So, make sure everybody can see me here. In your retirement years, what would be the reason that your income needs would suddenly skyrocket? Let's say you're living well on $100,000 a year and all of a sudden have to take an additional $70,000 on top of that. What do you think could cause that to happen? Illness, absolutely. Most would say some kind of health issue. Great answer, everybody. What if you or your spouse, if you're married, become frail and need some type of care? Where would you get that? In that example, that additional $70,000 a year. So when your income needs suddenly skyrocket, where do you get that money? Most people are going to liquidate their conservative assets first. So things like cash equivalents, CDs, money markets. Because if you have qualified dollars, that could be a pretty big tax hit. If you have second rental property or a second home, what if the market's not good? So people are going to typically liquidate those conservative assets first. Long-term care is an income issue, not an asset issue. All right, so is this going to affect your retirement income plan? If you have to take that additional money, are you going to earn enough income or assets to produce that income to pay for that care? Is it going to affect your retirement income plan? Will you outlive your assets? Here is a diagram of what we call the great income gap. So let's say you retire at age 65, you're living well on $100,000 a year, and maybe at age 75 you begin having some health concerns. Most people can probably absorb some of that cost because they've done well and they've planned in the event of an emergency. But let's say at age 80 you have a diagnosis of Alzheimer's and you need care for 10 years. That, my friends, is what we call the great income gap. So what are some of the concerns? I'm going to walk over here again. I like to walk around here. All right, speaking of Alzheimer's, 6.5 million Americans were diagnosed with Alzheimer's in 2022. It's crazy. 1 in 9 people over the age of 65 are diagnosed with Alzheimer's. By mid-century, 1 person every 33 seconds will be diagnosed with Alzheimer's. And by 2050, they're saying 12.7 million Americans will be diagnosed with Alzheimer's. That's pretty scary, isn't it? We better hope and pray that they come up with a cure, because it can be devastating as far as caregivers and cost. I'm sorry?
The rest of them will have dementia.
Yeah, true, very true.
That's just Alzheimer's.
That's just Alzheimer's, absolutely. All right, so here are the statistics, y'all. I asked you at the beginning to raise your hand if you think you need care. The actual statistics are 70% of people over the age of 65 will need some type of care. In fact, 1 in 5 will need care for 5 or more years. Here's the problem. Most people think they're in the 30%. And if they think they're in the 30%, they don't put a plan in place. But here's what we know. Most people that have invited loved ones into their life and promised to take care of will put something into place to protect those that they love. If you're married, oftentimes the spouse may take care of you. Maybe they feel obligated to, or maybe their financial situation will dictate it. And if you're not married, maybe the family will step in. Maybe it's the oldest daughter in closest proximity. Maybe she might quit her job and move in with you. Maybe you might move in with her. Your life doesn't end. Someone else's does. As I said, long-term care doesn't bring families together. It tears people apart. I have a plan so that my kids will talk to each other when I die, and so that they'll supervise the care rather than provide the care. This is really all about the family, y'all. Finances are secondary, in my opinion. So the point is, long-term care, again, doesn't bring families together. It tears families apart. Think about my family and the situation I just gave you. When my mom really needs care, and I'm doing a lot of the caregiving, how do you think Christmas and Thanksgiving are going to look when we're sitting around the dinner table? When I'm resentful towards my brother because he's closer than I am and he's not helping. Or maybe my little brother and little sister are telling me what to do with mom's money. I have seen families literally not talk to each other when mom and dad pass away. So it's really, again, about the family. So how do we mitigate the risk? There's really two main types of solutions. There's many solutions, but these are two of the primary ways that you can mitigate the risk. There's traditional long-term care and asset-based long-term care. Anybody heard of traditional long-term care? I like to use the analogy, renting your policy versus owning your policy. Traditional long-term care has kind of gotten a bad rap in the industry. And again, as Doug mentioned, I've been in the business for 27 years, and long-term care is all I've ever done. So I've seen that the landscape change in the long-term care industry. Traditional long-term care is like homeowners or car insurance. You pay into it. It's the cheapest way to get the most amount of long-term care coverage, but rates can go up like renting. If you die and you never use it, there's no death benefit. And if you change your mind, there is no exit strategy. Whereas the asset-based long-term care products are written on life insurance or annuity chassis, and they have a benefit whether you live, whether you quit, or whether you die. Again, owning versus renting. So here's a concept of asset-based long-term care. So if this is your portfolio, most people have conservative, moderate, and aggressive assets. And as I mentioned, most people are going to liquidate conservative assets first. Well, the government has allowed certain life insurance or annuity policies to be accessed while alive, tax-free for LTC benefits. So we could move money from I like to say move our money from our left pocket to our right pocket, or reposition that into a life or annuity policy. It's still an asset on the balance sheet, but if you live and need care, you have tax-free long-term care benefits and pennies on the dollar leverage. The insurance company is going to give you additional funds to pay for care. But if you die and never need it, in this example, you still have $125,000 that goes to your beneficiary. And again, it's still an asset on the balance sheet. If you change your mind, you can get some or all of your money back, depending on when you exit. So, how do we fund asset-based long-term care solutions? There are 4 primary ways that you can fund these. The first way is highly appreciated non-qualified annuities or cash value life insurance. Let's say, for example, you have an old life insurance policy. You don't need it anymore. You could reposition that into a policy that provides you long-term care if you need it, the death benefit if you don't, and again, that walk-away strategy. Next is cash or cash equivalent. So let's say you have money sitting in a CD that you're not utilizing for income, or maybe it's in mutual funds or in the bank. You can reposition that, as I like to call rainy day funds, into one of these solutions. Next, qualified dollars. A lot of people have money, pre-tax dollars, in IRAs and 401ks. That's how I've saved the majority of my money, because my employer matches. So a lot of people have a disproportionate amount of money in tax qualified funds. You can actually utilize those and put into these solutions and provide tax efficient ways to pay for LTC. And then last but not least, not everybody's in a position of repositioning lump sum dollars. You can fund these policies with income, just like the traditional. So you can typically stretch them out anywhere over 5 years, all the way to a paid to age 100, and anything in between. So from a cash flow perspective, that's the cheapest way to buy the most amount of long-term care. So let's look at some samples. This is where I get the most questions, so please feel free to stop me and ask questions at any time. So remember I said that the government has allowed certain life insurance or annuity policies to be accessed while alive tax-free. Well, we have long-term care annuities where we can reposition that annuity from our left pocket to our right pocket into a solution that's going to provide tax-free dollars for care. So say, for example, you have a $100,000 annuity and it grows to $150,000. Anybody know what happens when you take money out? You pay taxes on the gains in the policy. So we can wipe out those gains if you use it for long-term care benefits like home health care, assisted living, nursing home, adult daycare, etc. So in this example, we have a 70-year-old male and female. They have an existing $150,000 non-qualified annuity. They don't need to use it for income. We're going to put it in this long-term care annuity, and it's going to provide them roughly $5,000 a month per person, or $60,000 a year, and $450,000 day one of long-term care benefits. So every dollar that they put in, they get $3 for long-term care. Think of that $450,000 as a tax-free long-term care bank account. They can draw up to that $5,000, and that's each, until that $450,000 is gone. Again, think of that $450,000 as a tax-free long-term care bank account. If they both use it and go on claim at the same time, it would draw it down twice as fast. It is a 7.5-year shared bucket of money. So live and need care, a dollar turns into $3. Die and don't need long-term care, that $150,000 annuity will go to the beneficiary. And if they want to quit, they can take their annuity and walk away at some point. Depending on when they walk away will depend on how much they get. So again, all of these asset-based long-term care products have a live, quit, or die benefit. Does that make sense?
Mm-hmm. So this runs for 7.5 years?
Yes, sir.
And then after 7.5 years, can you renew it, or is this was a one-time shot on this?
So it's one and done, and I don't know if everybody heard the question. He said, once it's 7.5 years is up, can you renew it? So the way it works is once the $450,000 bank account is gone, the policy's gone. There is no more bucket for long-term care, and you would have an out-of-pocket expense.
What if you didn't use the $450 in the 7.5 years?
That's a great question. So the way that it works, it comes out of the pool of money, dollar for dollar. So your money is, you use your money first. So if you use $100,000, you pass away, $50,000 goes to your beneficiary. If you use $150,000 and then $100,000 of the insurance company's money, there's nothing left. What you're doing is you're using your money more tax efficiently, and you have pennies on the dollar leverage for LTC. Does that make sense? Great questions. Any other questions before I move to the next case study? All right.
What happens if you don't use any of it, that $150,000 goes to the beneficiary?
It is, great question. So this is a fixed annuity in this example. So you're earning a fixed interest rate. Now this is not an investment vehicle. I'll go ahead and tell you, Doug can make you a lot more money than this product can. This is going to be like a CD equivalent. I think right now it's around 4.5% less the insurance charges. What I can tell you is you'll never lose a dime. Like even if the cost of insurance for that additional long-term care bucket is more than the interest earned, someone's still walking away with $150,000. But if you don't use it, chances are you'll see some gains in the contract. Great question. Any other questions on that one? All right, don't be shy. All right, so our next example is cash or cash equivalent. This is a 60-year-old couple. They have a CD. They don't need income. They don't have a long-term care plan in place. They've got $200,000 they want to reposition into a long-term care policy. So this is a life policy. Again, $200,000 to cover the life insurance. It's kind of like a timeline. In that example that I gave you, the concept of asset-based long-term care, the first portion, which is the base policy, is your money. That's the life insurance policy. Then you're adding a rider that's going to continue to pay if you live long enough and need care for the rest of your life. So this is true longevity protection. So what does this get this 60-year-old couple? It's going to give them around $8,600 a month per person, lifetime income stream to pay for home health care, nursing home, adult daycare, hospice, the whole shooting match. If both people need care, it's going to provide roughly $17,000 a month lifetime income stream. So in that example that I showed, the great income gap diagram, if they needed care for 10 years, this would pay $8,600 for the entire 10 years. You can do any, the good news is there's 101 different ways to structure these. The bad news is there's 101 different ways to structure these, which is why you have a team here to be able to help you, because you're all individually different and it's not a one-size-fits-all approach. So you can do any variation of a 2-year benefit all the way to an unlimited. So this is the most longevity protection you can get. So again, $8,600 a month per person, $104,000 a year lifetime income stream. Here's the beauty of this. It would take 52% guaranteed return on your money to equal $104,000 for life. If both people needed care, it would take 104%.
Can I sign up for that 104% thing for you?
You sure can. For long-term care purposes, if you know someone that can get you 104% return on your money, sign me up too. All right. Now, if they wake up an angel and never need any care at all, there is a second to die death benefit. So in this example, the death benefit is $288,000. Now, is it a great big death benefit? Probably not. We could probably put it into a plain vanilla life insurance policy if you don't need care that'll give you a great big death benefit. This truly is long-term care first. The life insurance is secondary. It's, oh, by the way, if you don't use it, you don't lose it. Does that make sense? Mm-hmm. Any questions on this one? Yes, sir.
Restate what you just did about, did you say secondary death benefit or second death benefit?
Second to die. So the way that that's a great question. So the way the death benefit works on this example, it is a joint second to die life insurance chassis, meaning the death benefit doesn't pay out until both people pass away. Great question. Any other questions on this one? Awesome. All right, so this next one's a little bit more complex. How many of you all like to pay Uncle Sam? Nobody, right? Before I go through this example, this is based on qualified money, so you haven't paid taxes on this. The bad news is you're never going to get out of paying Uncle Sam, right? They want their piece of the pie. What I'm going to show you what we can do is tax efficiently do that and provide tax-free LTC. So here's an example of a 70-year-old male and a 71-year-old female. Now, RMD, or required minimum distribution age, has gone up. It's now, 73? So you don't have to take it till you're 73, but I don't know about y'all, but in my opinion, taxes are on sale right now. Okay, so we're going to start them early and we're going to pay taxes while they're on sale. So in this example, they have $200,000. I'm going to go back over here so I can see. They have $200,000. They're going to move that from their left pocket to their right pocket. Immediately, $200,000 gives them a 25% bonus on their money. So now we're looking at $250,000. It doesn't say that, but hopefully my math is right. Just kidding. So anyway, $25,000 they're going to turn on an income rider to fund a 10-pay life insurance policy. So again, we're moving it from our left pocket to our right pocket. We're going to turn on income rider on. It's going to buy a 10-pay life insurance policy. I like to call this the McDonald's Happy Meal. You can buy your hamburger, fries, and drink separately, which I'll show you in a minute. But this is literally one transaction. They're going to do the rest for you. Now that $25,000 that comes out every year is a taxable distribution because we're never going to get out of paying Uncle Sam. What we're doing is we're spreading the tax liability out over 10 years. It's kind of like a Roth conversion if you're familiar with that. And again, you're turning those taxable dollars into tax-free LTC benefits. So what does one $25,000 payment buy them? It's going to give them $53.14 a month tax-free. So if they needed care in year one, let's say, God forbid, one of them have a stroke and needed care, it's going to pay out immediately $53.14 per person for as long as they live and need care. This is a lifetime benefit. If both people needed care, now we're looking at roughly $10,000 a month. Lifetime income stream to pay for that nursing home, home health care, etc. Now, if they die and don't use it, there is a $177,000 death benefit. Now, is that as much as they put into it? No. But guess what happens when you pass an IRA to your kids? Anybody know? They have to pay taxes on it, right? Because Uncle Sam's not letting us get away with not paying taxes on that money. What you're doing is you're providing your kids a gift. You have paid the taxes for them. So if you die and never use it, that's all going to go to your beneficiaries tax-free. And once you get to RMD age, it also satisfies that required minimum distribution. So I know that's a lot of moving parts, so don't get caught up in all the details. We can, go on over that one-on-one. But the idea here is we can use qualified money, roll it directly into these solutions, provide tax-free LTC benefits, spread the tax liability out, and give your kids a death benefit or whomever if you don't ever need it. So it's a great solution using retirement, qualified money if you have a disproportionate amount of money in those funds. Does that make sense? Again, I know that's a little complex, but I want you to understand really conceptually that you can use those funds.
What does it mean, funding a 10-year pay base?
So the base policy is nothing more than a life insurance plan. So the base policy, yes, so even after 10 years, the life insurance is still intact. But what it's doing is it's funneling the money out of the IRA into the life policy. And at the end of 10 years, there's nothing left in the IRA. It's all in the life policy. So if you die, for example, in year 5, there's still money in the IRA. You'll get the 177 plus what's left in the IRA. So your death benefit's going to be higher until it's all out of the IRA and all into the life insurance policy.
And that is the idea of lowering the taxes, paying over 10 years instead of one lump sum?
Yeah, absolutely. That's exactly right. So the idea here is to spread the taxes out, provide tax-free benefits, a death benefit if you don't use it, and you're reducing your tax consequences in the future because you have less IRA or less qualified money in that bucket. So great observation. Any other questions on that one? Yes, ma'am.
So if you're taking out $25,000 a year, say we only use it 5 years and both of us are gone,
Mm-hmm.
do our beneficiaries have to pay the remainder of the $200,000 that haven't been paid?
No. So if you die halfway in year 5, they get the 177 your beneficiary does that's already tax-free, but then whatever's left into the IRA goes to them as well. Now they will have to pay taxes on that bucket because it's not on the tax-free side of the house. But yes, you don't lose that money if you die in year 5. The other thing to keep in mind too is let's say you need care in year 5. That $25,000 is now waived, and the distribution, instead of going into the life policy, goes in your pocket as income. Plus you're getting the long-term care benefits. It's really a unique solution and the only one of its kind out there. Does that make sense what I said? It's got a built-in waiver of premium.
Restate that again, so you take the policy, it's a 10 pay, you're in year 5, you need to start drawing on it. Your premiums waived for the rest of the...
As long as you're on claim, the remaining 5 years of payments will go in your pocket instead of the insurance company's pocket. Plus, you'll get that $53.14 a month.
And this is a dual plan, husband-wife plan?
It absolutely is. You can use one person's qualified money to fund 2 lives.
Okay.
You can also do it individually too as well.
All
Great question.
right. So, big picture, you started out how much long-term care costs us? And we're looking at today's dollars. Well, none of us need it tomorrow.
You're right. You're right.
So we need to go to that website and look at when we think we're going to need it, because the amount that this is paying probably isn't going to cover what is there. Is this to offset it, or do we look at that?
So in my opinion, it's to offset it. Typically what I recommend as a starting place, let's cover at least 50% of the high-end risk, which is nursing home, and that'll typically cover almost 100% of home care and assisted living. Then you can dial it up or down based off your comfort level as to how much of that nursing home risk that you want to cover. You can also put inflation on these. I just conceptually want you to understand how they work, Because again, there are a number of different ways that we can structure them. We want to make sure you have enough coverage when you actually need it. So that's a great point. Any other questions on this one? Yes, sir.
You were talking about at some point the $25,000 goes in your pocket, but you're still paying taxes on that.
Yes, you'll never get out of paying Uncle Sam. So whether it's going in the insurance company's pocket or your pocket, you're going to get a 1099 for that $25,000. Great question. Yes, sir?
This example gives you a male 70 and a female 71. Can we change that to 60 and 61? Or is
Yeah.
this,
Yeah, I'm just giving you an example. So we can, as long as you're 59 and a half, this is a great solution. The younger you are, the more you'll get. And interest rates have gone up in the past few years, so cost of insurance has gone down. You can get way more coverage now than you could 2-3 years ago. So now's a really good time to jump in. And the younger you are, which I'll say this again at the end, I love this statement, the younger you are, the healthier you are. So now is really the time to start having those conversations. But good question. If you were 60, it'd be more benefits in this example. Any other questions? All right, one more. All right, so income. As I mentioned earlier, from a cash flow perspective, you can fund these anywhere from typically 5 years, meaning you pay in for 5 years and then you're done, no more premiums, all the way to a paid to age 100. This is an example of a 62-year-old female. She's a high income earner. She's going to retire in roughly 10 years, so she wants to pay it off in 10 years. $14,172 is guaranteed, so unlike renting, these rates will never go up. She knows exactly what to expect. That's going to get her $6,000 a month for 6 years. That's $72,000 a year, and that's tax for everything that I'm going over tonight is tax efficient. So this is tax-free long-term care benefits. It's got 3% compound inflation. As you mentioned, this is today's dollars. We might not need care for 20, 30 years. We're living longer. That's going to increase that $6,000 a month and that $72,000 a year based on 3% compounded every year. So I believe, and I'm no mathematician as I admitted, what does it take, about 25 years, guys, to double your money for 3% compound? Anybody know? I think it's close to that. So we'll just say somewhere between 20 and 25 years. So now that $6,000 is worth $12,000 a month when she needs it. So that's going to cover the majority of home care, assisted living, and then she would have to supplement some of the facility. And the reason I start with home care at that amount insuring is because we all want to stay in the home, don't we? Nobody wants to go into a facility. Now that doesn't mean that we won't. Sometimes you bypass home and go straight into a facility. We don't have a crystal ball. But what I at least like to start with the coverage of at least home care and assisted living. Yes, sir?
How's that money distributed anyway? How is it by receipts turned into it?
Great question, and thank you for asking that. I was going to get to that here in just a minute. So long-term care has 2 ways that they pay out policy benefits. There's reimbursement, which is submitting bills and getting paid back, or these newer policies, you can have it pay directly to the care provider. So don't be afraid of reimbursement policies because they're not all that bad, especially if you have bad family dynamics and if you have a cash benefit and your kids take you out back and hose you off. Kidding, but you get the point. So there's reimbursement, and then there's what's called indemnity. This particular example that I gave, they'll send you a check. You can do whatever you want with it. Again, good family dynamics. But if you want, for example, a family member to take care of you, the indemnity option would be the better option. Now, again, I have a policy so that my kids will not take care of me. So that doesn't matter to me. But if it matters to you, then you would want to go that route and make sure you're looking at a cash plan. This one, too, I didn't mention, has a $144,000 death benefit. So if you wake up an angel and you don't need it, that $144,000 goes to your beneficiary. Now, let me get back to what you were asking is how does it pay? Because I know everybody wants to know this. How do you trigger the benefits? So the way that all of these work is if you can't perform 2 of 6 activities of daily living, so that's your everyday stuff, bathing, dressing, toileting, transferring, eating, and continence. If you can't do 2 of 6, or you have a cognitive impairment like Alzheimer's, then you will trigger these plans. Now, all of these plans have what's called an elimination, kind of like a deductible with homeowners or with health insurance or car insurance. You're going to see anywhere from a 0-day to a 90-day. This example is a 90-day. This example right here is a 0-day in the home, 90-day for facility. If you use at least 90 days in the home, it's going to count towards the facility elimination. So 2 of 6 ADLs is what they're called, activities of daily living, or cognitive impairment. You go through the elimination, then the policy benefits begin to pay. Does that make sense as far as how those work? And just to reiterate, these policies can be used for home care, assisted living, nursing home, hospice, adult daycare. They are fully comprehensive. And if you have a cash plan, if you want to go to Vegas, drop $5,000 on the slot machine, you can. But again, those are a little bit more flexible as far as those payments.
And what's the definition of cognitive impairment?
Severe cognitive impairment. So if you are, and your doctor certifies those ADLs. So it's severe cognitive impairment. You're a danger to yourself. You can't remember to eat. You can't remember to take your medication. You can be healthy as a horse and not have any cognitive, you might have some cognitive issues, and you forget to dress yourself or bathe, and you need supervision just to eat, and that would automatically, you don't need ADLs to trigger that. It would just be based off of the cognitive impairment.
And that is Alzheimer's and dementia?
Alzheimer's, dementia, anything that causes a cognitive impairment. Any other questions? Sure. Bathing, dressing, toileting, transferring, that's moving from one place to the other, like getting out of the chair and going to the bed. So bathing, dressing, toileting, transferring, eating, and continence.
What was the last?
Continence, yeah.
So the 90-day deductible again, you go in a facility, and none of these examples start paying for 3 months.
So in these examples, no. There are other solutions out there that don't have an elimination at all, or they have a retro elimination. These are just, I just gave you 4 examples from 4 funding opportunities. And then, again, we can customize those based on, because again, all of y'all are different. You may be funding it differently, maybe your health is different. There really is a solution for everyone, so all of these particular examples have underwriting. Some have more than others. Some are simplified underwriting. Some are just a questionnaire. We have one that's guaranteed issue. So diabetes, for example, could be underwritten 5 different ways with 5 different carriers. So it really is, I mean, I know I'm beating a dead horse or whatnot, but it is really different and going to be unique based off of each individual person. Because, 5 of you might also fund it 5 different ways as well. So I would encourage you to investigate your options for sure.
So you're saying there's a policy to fit every need?
There is a policy to fit every need. You can self-fund all day long, but this is a more tax-efficient way to pay for care. And if you don't use it, you don't lose it. The old school, I like to call it old school long-term care, which is traditional, you pay in all these years, and then if you never need it, there's no benefit. There's no death benefit. And unfortunately, I've seen them, the prices skyrocket. I've seen them go up anywhere from 15% to 250%. And these solutions here all have guarantees, and they can't do that. And that's what we really like about these type of solutions. All right, so let's get to the end here, and then I will open it up for any additional questions. So what I would encourage you to do, again, because you're not the same and you're all uniquely different, is schedule a meeting and explore all your options. There are annuities with income doublers. There's chronic illness riders. There are short-term plans. There are a number of different ways that you can insure against this risk. I just touched on the surface, some of the more popular options. So I encourage you to investigate it. And I will mention too, before I really wrap up, the other thing I'd encourage you to do is have a written plan of care. There is nothing worse than having to reactively deal with it when it's like your house is on fire and, oh gosh, what do I do? Same with long-term care. Tell your family who you want to take care of you. Tell your family how you want to pay for it. So even if you don't put a solution in place, let them know. If they're going to be taking care of you, let them know, honestly, so that they know that. But give that to them, get that written plan of care and give that to them. That's the number one thing I would recommend. All right, so if you do complete a plan, make sure you give that information to your kids so if something happens, they know how to access it. And then last but not least, as I mentioned before, you've never been younger and healthier than you are today. And with that, I'll open it up for questions before Doug closes us out. If there's anything else, any questions?
Alicia,
Yes, sir.
I've been writing these policies for a couple of years now, and is it my imagination, or say somebody puts in a $200,000 premium, is that buying a larger monthly benefit now than it was, say, 3 years ago?
Absolutely, because interest rates have risen. One of the reasons that cost of insurance became so high on these types of products is because there wasn't enough margin to be able to give you a bigger benefit. And so with interest rates on the rise, they've been able to give you more bang for the buck. So you're absolutely getting a bigger benefit now than you were getting 3 years ago for the same age.
So conversely, if interest rates stop dropping, one would assume that this would be a prime time to...
Absolutely, because if interest rates start going down, they may reprice the products. So they might look differently a year from now.
So it's not my imagination. Okay.
Nope, not your imagination. Any other questions? All right, hopefully.
Actual insurers, who are the actual companies underwriting these?
There are a ton of companies. It depends. I mean, some of the examples I gave, One America, Global Atlantic, Securian. I mean, there are a number of different carriers. We are independent, so we use them all because, again, it's not a one-size-fits-all approach.
And they're all A-rated, by the way.
Yeah.
Yeah, that's a good question. So is there a possibility that an underwriter goes belly up, emerges, and null and voids policy somewhere down the road?
So that's a great question. So in every state, there's a state guarantee fund. I hope that we never have to use those. In my tenure in the long-term care industry, I've seen one carrier go belly up, and it was a traditional company, and if you fogged a mirror, you could get coverage, and it was super cheap. So it doesn't surprise me, but guess who picked up the bill? The State Guarantee Association. So yes, the taxpayers. Yes, actually the insurance companies all contribute to that.
Do you have to qualify for these, like, do they give you medical records?
So great question. So how do you qualify for these? It depends on the company. Some are phone interviews only. They're simplified underwriting. Some will investigate your health a little bit more and possibly do medical records. Some don't have any underwriting at all. Now, the ones with no underwriting at all don't give you quite as much leverage. I mean, you can understand why. But they're all different. There's no two companies alike as to how they underwrite. I would say the majority of our carriers for long-term care are simplified underwriting. There's only a couple that will do a little bit more investigating, but that's because they're willing to take on more risk. You just might have to pay a little bit more.
Does that result in tiers of coverage if you have, say,
So,
a pre-existing condition?
so pre-existing conditions could potentially cause your rates to go up a wee bit, but they're not going to exclude the pre-existing conditions. For example, one of the solutions I showed you, the annuity, if you have cancer, you're receiving treatment, you can still get it, but instead of tripling your dollar, you're going to double your dollar. So 100,000 would turn into 200,000. So that's why when I say there is a product or a solution for everyone, there really is.
And by the way, we had to use one of those last year with a client because they didn't qualify for the regular one. And Doug Garrett and I were actually very impressed with the benefits that was
Yeah.
provided. We thought they'd be a lot lower. And they
Yeah,
really weren't.
and tax efficiency. So that's really what the name of the game here is. If you don't have a plan, your money is your plan anyway. What I just showed you is a more tax efficient way to use your money and pennies on the dollar leverage. Does that make sense? Because the annuities don't have any income riders. That's not what they're built for. They really are built for long-term care planning. You're going to put them in your lockbox and hope and pray you never use them. But if you do, someone's going to get a benefit.
Anybody else? Alicia, thank you so much.
You're welcome.
Thank you all for coming out tonight. I hope you got some golden nuggets of information. You YouTubers, thank you for tuning in tonight. As I said before, if you want to come and talk to us about anything you heard tonight, there is a little pad at every table. What I want you to do is I want you to write your name and phone number down on it and turn it into joy on your way out. Now, if some of you want us to do a retirement plan for you, and it will cover long-term care too, then I want you to put your name and phone number, and underneath that, write retirement plan, okay? I want to remind you also, next month, Casey O'Day will be in the house September the 10th, but you absolutely must register because it's going to be a full house. And the way you register is giving us a call. Talk to Lynn, and you could go on our website on the wealthguardians. Nope.
The date for KCB here is the 11th.
The 11th, I'm sorry.
The 10th is when you deal with that other event.
Yeah. So it's the,
If you get our emails, there'll be a reminder in there. If you want to just register right there through the email, do that.
all right, guys, thanks for coming out. And, you know, I'm a big believer in asset-based long-term care. I think a retirement plan is not complete without long-term care because I'm sure everybody in this room has probably had an experience with a family member or a friend when it comes to care. And I love the idea of moving qualified money into a plan like this because it's very similar to a Roth conversion, and we're big, big believers in that. Good night. Drive home safe.
Yeah, thank you.
One last question.
Sure.
On average, based on your experience, when someone
It's the
goes
11th,
into
yeah.
assisted
He has
living
another
or
event
rest home,